Good afternoon, advisors, and welcome to our final webinar this year in our 2014 webinar series, Insurance by the Numbers. Today's presentation will last about 50 minutes, and during that time, if you have questions as we go along, feel free to ask them on screen. We'll do our best to answer them timely. This webinar is being recorded and will be posted to our website within a week. Regarding CFPCEs, if you are logged into the webinar today for more than 50 minutes using the email address you registered with, we will report your attendance to the CFP board. That process can take up to about a month. This month's number is 10, and we'll show you how reallocating your client's assets can improve their financial security with 1035 exchanges. Your presenter today is Mark Maurer, LLIS's President and CEO, a CFP and an MBA, who constantly monitors the insurance and financial services industries. He's a member of the National Association of Insurance and Financial Advisors and a frequent speaker for NAPFA, ACP, Garrett Planning Network, and other organizations seeking insurance-related education. And now to introduce a man we think of around here as a perfect 10. Oh, and by the way, he also signs our paychecks. Here's Mark.
Thank you, Dina. Well, she stole what I was going to say about Dina being a perfect 10 marketing and coordinating person. So, Dina, thank you for everything you've done all year for getting all of these PowerPoints and presentations all set all year. So, thank you very much. Any of you who've had a chance to work with Dina or meet her, you know how great she is. So, we're at number 10. It's December. We're at number 10, 10 being awesome, 10 being usually the best number that you can wear if you play professional soccer. 10 is also lots of other good things. I think what else comes in 10s? But Bo Derek. So some of you remember that. Some of you have no idea who that is. Dating myself here. All right, moving forward, 1035 exchanges. We're going to talk about what is a 1035 exchange. One of the things that we can do, and we're going to talk about a lot of different options of 1035 exchanges, and one option being a 1035 exchange to a term UL policy, and other ideas. What is a 1035 exchange? 1035 exchange is probably my favorite and most interesting thing that I get to do on any given day, because 1035 is 1035 is actually a section of the Internal Revenue Code, and so that's why they're called Section 1035 exchanges, or just shortened to 1035 exchanges, that allows for the transfer of cash values between insurance policies. And the IRS says because it moves from insurance company A to B, the client, the insured, the owner never takes possession of the cash values. There's no taxable event as long as the cash values transfer between the same owners and the same insureds. So for all of you listening, when I say think an IRA rollover, it works exactly the same way. If I cash in my IRA, then I'm taxed on it. If I transfer my IRA from Vanguard to Fidelity, or Fidelity to Schwab, or wherever, when it's done from custodian to custodian, it's a non-taxable event. And I said, why do I love 1035 exchanges? 1035 exchanges are like a puzzle every day. There's a client situation. They have X dollars in cash value in an insurance policy. So that's our constant. That's our fixed value that we say, okay, here's the client. They have X in a policy. What can we do with it? And then there's any number of different things that we can do, and that's why I said it's one of my favorite things to work with, because it's like a puzzle. Given this, what are all the different things we can do? Well, first off, how can cash values move? They can move between insurance policies. And so it makes sense that I can transfer the cash values in one life insurance policy into another life insurance policy. It also makes sense that if I have an annuity, I can transfer the cash values into another annuity. Same owners, same insured, even here, same policy type. Now the IRS says you can also transfer the cash values of a life insurance policy into an annuity. Why? Well, most of the aspects stay the same. Tax-deferred earnings, a lot of different variables there, but I'm actually giving something up in the form of the death benefit. And so the IRS says then, okay, it's not an even swap, but you're not bettering yourself by doing the 1035 exchange, which is why the IRS says you can't do a 1035 from an annuity into a life insurance policy. An annuity death benefit is not income tax-free to the extent that there's a gain in an annuity. To the extent that there's a gain in a life insurance policy, the death benefit is still income tax-free. So the IRS has said, nope, can't do one of the four transfer options here because it actually would provide better than what you had, and we're the IRS, we don't like stuff like that. A few weeks ago, an advisor called us and said, we have this client, and she has this policy. Mark, what I'd like you to do is just give us some options because I know there's lots of things we can do with this policy. We're not even sure what we may or may not want to do, but give us all the different options that you can come up with. So I said, okay, tell me about your client. Well, the client's Lucy Ann, and she's age 52. She's retired, and her net worth is about $4 million. She has children. She has a long-time live-in boyfriend, and she has this policy. And what is this policy? It's a $320,000 group universal life policy that was issued in 1992. And so she's recently retired from that employer, and so she had this policy. While she was working for this employer, they were paying the cost of insurance and premiums. It was not unlike an employer paying for life insurance through term or what have you, but in this case it was a group universal life policy. And the employer was paying the premiums. And many of you have asked us or talked to, seen this with your clients. While your clients are working for an employer, very often the employer will pay the annual cost of insurance just to keep the policy in force, basically funding it like 1 year annual renewable term, and the employer pays for that. Then they're also pitched on the idea that, well, the employer is paying for the cost of insurance. Anything you put in additional will be will earn an income rate, whether it's a variable or fixed rate. The earnings will be tax deferred. What usually is a drain on the earnings portion is the fact that there's those costs of insurance coming out every year. But when the employer is paying for the cost of insurance, the money going in is earning the interest and isn't having the cost of insurance be a drag on any returns. And so Lucy Ann did some of that. And today she has a cash value of just over $102,000 in this policy. And her cost basis, or the sum of premiums she's paid in on an after-tax basis, is just under $66,000. And this policy is what's called an option B, or increasing death benefit policy. So the stated policy is for $320,000 face amount policy. Option B says, and that face amount will be increased by the cash values in the policy. So today, if Lucy Ann died, her beneficiaries would receive $422,000, which is the $320,000 plus the cash value of the $102,000. Now, some of you may have noticed, since we're talking about 1035 exchange, you saw that we have a cost basis of $65,000, and we have a cash value of $103,000. So what does that mean? That means there's a gain in this policy. So option one I posed to the family financial advisor was, option one is, if she doesn't need or want any of it, she can just simply surrender the policy. Here's the problem. She If she surrenders the policy, then she is taxed on all of the gains. In this case, that's $37,000 of ordinary income that is taxed to her this year. Now, I love the little graphic. It's like the money there, but maybe not. The worst thing in the world is not to pay taxes. But Lucy Ann's situation, she has a high net worth. She doesn't need or want additional ordinary income. And so the advisor asked us, what are all the different ways, Mark, that you can think of to avoid sticking my hand in this mousetrap right there? 1035 exchange. We move the cash values into a different vehicle, and the different vehicle that doesn't require her to pay those $3,200 in premiums a year. I think I forgot to mention that. The employer was paying those premiums, has been paying those premiums since 1992 while she was working. This year when she's retired, she becomes responsible now for all the costs of insurance. The policy has the cash value, and it wasn't going to carry very long because the employer's been paying just this ART every year. So her premiums are going to jump. She doesn't want to pay those. And so we talked about other ideas that don't require any premiums for her out of pocket. So option number 2, we could do a 1035 exchange to a single premium immediate annuity. And for all of you familiar with it, a single premium immediate annuity is a contract between a person and an insurance company that for X dollars of premium today, you will pay me Y dollars for either my lifetime, a specified number of years, or some combination of both. It creates an income stream. So rather than either surrendering the policy and having a lump sum today that's taxable, or keeping the policy and continuing to have premiums flow out, 1035 to a single premium immediate annuity creates an income stream in. But SPIA doesn't eliminate paying ordinary income tax on the gain. What it does is it creates an exclusion ratio. An exclusion ratio is the IRS's way of sort of being nice. And it says that when you annuitize, each portion, we're going to, over your life expectancy, we are going to return each part of your cost basis and part gains in each of those payments. So this year, if Lucy Ann started a SPIA, each payment would be part tax-free return of basis and part ordinary income. But what does it do? It spreads the gains and the tax over the length of the payments. If she surrenders the policy today, that's $38,000 of ordinary income this year. If she spreads the payments out over a 10-year period certain, or her life only, she'd receive payments of $975 a month or $441 a month. And the IRS's tables for the exclusion ratio are 56% for the 10-year period certain and 39% for the life-only payment. The IRS says at her age, or the particular payment, how much of each payment is going to be tax-free. That's the exclusion ratio. That's the part that it's excluded from having to pay tax on. So if we did a 10-year period certain, if that was of interest to her, then for the next 10 years, about half of each payment would be tax-free return of her basis, and about half of it would be taxed as ordinary income. The gain would be taxed as ordinary income. And so rather than paying $38,000 of tax all in 1 year, she's only going to have about $5,000 of ordinary income tax each year spread out over 10 years. The $38,000 would have bumped her into a new tax bracket. Then this makes a lot of sense, especially if we can keep that tax brackets lower. Had we gone to a life only, well, because the payments are going to continue for a much longer period of time, she's not going to return her basis quite as fast as with the 10-year period certain. And so 60% of each payment would be considered ordinary income tax, 40% tax-free basis. This is the only way that we can have this exclusion ratio. An immediate annuity is the only type of policy that allows for this. A regular annuity, deferred, variable, if you start taking withdrawals, then you are start taking regular withdrawals, then the income coming out is all of your gains first, and then once that's used up, then you get to your basis. The immediate annuity is the only one that spreads those out over the policy. What's the planning plus? Well, with a life-only payment, there's no value at her death. She has $4 million. She's not married. She can't use her boyfriend for the marital estate planning to join a husband and wife to get to the $10 million plus. So right now she's getting pretty close to having an estate tax issue. With a life-only payment, there's no value in her estate at her death. So as long as she's alive, she gets the $441 per month. But at her death, because it's a life-only, that value isn't included in her estate. Now, if she surrenders it now, it's $100,000, but if it grows over the next 30, 40, 50 years, then that can possibly, cause estate tax issues. Where with an immediate annuity, the fact that it's life-only, income for as long as she lives, nothing at her death. And the other plus is there's no underwriting. No paramed exam, no medical records. If she was interested in the idea of the immediate annuity income stream, it's relatively straightforward. Planning option number 3 would be the 1035 exchange to a deferred annuity. Now, where an immediate annuity starts an income stream right away, a deferred annuity does just that. It defers the growth and earnings in the annuity for a period of time. So whether it's a fixed annuity or variable annuity, both options allow for continued tax deferral until the benefits are accessed, either by withdrawals. And as I mentioned, if you start taking withdrawals from an annuity, in this case we know she already has a gain. She takes withdrawals. All of her gains are taken out first. And once gains are exhausted and paid taxes on all that, then she's getting her return of premium back, or cost basis. Or with a deferred annuity, she could always choose to annuitize it, whether within that contract or by doing a 1035 of the deferred annuity to an immediate annuity. And then we create that exclusion ratio again. Or Lucy Ann kicks the bucket and the annuity pays benefits via the death benefit. With an annuity, and I touched on this with the 1035 exchange, with an annuity, if someone has an annuity and it passes on as a death benefit, we often hear the words death benefit and think it will be income tax-free like life insurance. It's not. If Lucy Ann happens to pass away 2 days after getting the annuity, the benefit is paid to her beneficiaries, and the beneficiaries then will have the same cost basis and the same amount of gains taxed as ordinary income that they have to do something with. Again, if anybody wants to name me the beneficiary of a $150,000 annuity, I'm not going to complain, but depending on what the ultimate goals are, may or may not be the best design. And because it's a deferred annuity, it's just like a regular asset. The annuity value at her death is included in her taxable estate. So what's a planning plus? It defers the tax. It's a deferred annuity. That's really the goal, the oomph here is that there's a big gain in this policy, in her existing policy. She doesn't want to pay the premiums. So the annuities also have minimal costs. There's very little. There's maybe some mortality and expense charges. If it's a variable annuity, there'd be some fund expenses, but fund expenses would be the same if they were in a brokerage account. If it's a fixed annuity, there's going to be some guarantees as well. But compared to life insurance, it's going to have the cost of insurance every year and her $3,200 in annual premiums if she kept the group policy, minimal cost. Again, no underwriting. I would say it's simple. It's insurance. Nothing in insurance is simple. It's all needlessly complicated most days, but no underwriting, no paramed exam, mostly just paperwork. Now, you noticed we flip-flopped this a little bit. Another idea for a 1035 exchange to a deferred or variable annuity was if maybe she was in a significant loss position. This isn't her, this isn't Lucy Ann, but her sister, Macy Ann, is in a significant loss position. This would be a great idea, a great plan to rebuild value. And I'm going to touch on this a little bit later. But if she, Macy Ann, happened to be in a loss position, she surrenders a policy, she can't deduct the loss. But if by deferring you're almost deferring a loss instead of deferring a gain, moving the cash values into a deferred annuity, she has the option to build her cash values back up to the cost basis and then surrender for the cash and pay little to no tax because we've grown the cash values maybe back up to or just over the cost basis. So I keep talking about Lucy Ann. We're going to bring her back in just so everybody can remember what we're talking about. She has a current policy with a death benefit of $422,000, a cash value of $102,000, and a cost basis of about $66,000. Her premium that she's going to have to pay to keep this group policy is $3,200 a year. So now we move to option 4. Option 4 is a 1035 exchange into a single premium, no lapse guarantee universal life policy. Now instead of moving from life to annuity with income stream or life to an annuity that's just growing and deferring taxes, now we're moving back from life insurance to life insurance. And what is a no lapse guarantee policy? For this, the phrase no lapse guarantee, most insurance companies have a policy of this type, that for X premium dollars, Y death benefit is guaranteed for the client's lifetime. It doesn't necessarily guarantee growth in the cash values, and a lot of these have very little cash values as time goes on. Not necessarily a lot of flexibility, because the guarantees to be able to be carried out to age 100, 105, 121 are based on keeping the premium today being kept in the policy the whole time to cover those higher costs of insurance later on. So it's a design for someone who wants to maximize a legacy to someone, wants to maximize the death benefit, but also isn't going to need access to those cash values. They've earmarked those funds, the premium dollars, to say, leaving a legacy to someone is important to me, and so here's an option to do that. So using Lucy Ann's current cash values and a standard health class, not a preferred or super preferred, standard rate class for her, the Columbus Life Advisor Plus Universal Life Policy with the no lapse guarantees would guarantee $663,000 of death benefit for her lifetime, using just the 1035 exchange she has and no additional premiums. So remember, her current policy was $422,000, and to keep that, she was going to have to start paying about $3,200 a year. With this policy, $663,000 is guaranteed for her lifetime with no future premiums. As I touched on, most no-lapse guarantee policies don't have cash values long-term. They may have some initially, but longer-term, when someone's in their 80s, 90s, then those lifetime guarantees are what's in there almost a pure death benefit policy at that point in time. It's designed to maximize the death benefits. I had somebody ask a question, and I don't touch on it here, but the question is, do any of these single premium no lapse guarantee policies allow for prepayment of death benefit for terminally ill insureds, or if someone's in need of long-term care coverage? And the answer is yes, a lot of them do. Most policies, the terminal illness rider is usually defined as someone who has a life expectancy of 12 months or less. And usually this is just a state-by-state basis. Some states say, yes, insurance policies can have that. Some say they don't. I believe it's in most states, most insurance companies and policies have that language built in. But then there are the long-term care riders, and some carriers have those as a no-cost option, where you can access part of the death benefit almost as a lien against the death benefit. Some policies have additional riders that you can add onto the policy that would provide for 2% of the face amount each year, or lots of different options for the long-term care rider component, and we're going to touch on one of those here in a little bit. But just depending on the design, usually you're trading or evaluating the most death benefit to long-term care benefits, and so there's lots of different flavors there. Now, the Planning Plus here, the gains are transformed into an income tax-free death benefit. So if Lucianne surrenders the policy today, she will pay ordinary income tax on it. If she got hit by a bus tomorrow, then her beneficiaries would have $422,000 income tax-free. With the 1035 to the no-lapse policy, we know that they would have $663,000 income tax-free. So we're taking all those gains, and instead of taking them as income and paying the tax, the magic of life insurance allows those gains to be transferred into tax-free death benefit. Now, if she owns the policy outright, the death benefit, in this case is $663,000, is included in her taxable estate. With $4 million, adding $663,000 to that starts edging her up pretty close, and she's still only in her 50s. She could transfer the policy. She could gift the policy over a few years using annual gift exemptions to her boyfriend, her children, an ILIT. She could make a gift all at once. So there are a number of ways to get the cash value of the death benefit out of her estate, but would require some planning. I had somebody else ask another question. These are all very good. The question is, could you do the 1035 exchange and then take a withdrawal for the gains and then keep the remainder in a single premium UL policy? And the answer is yes. That's always an option if someone wanted to have access to some of the money and then just use the gains towards a life insurance policy as well. So yes, there's sort of two ways you could go about that. One would be to take a withdrawal initially out of the existing policy up to cost basis, probably not quite up to cost basis, but some amount, and then do the 1035 exchange, or do the 1035 exchange and then in a year or two or 4 or 5 years down the road, take a withdrawal up to the cost basis and then use those cash values as well. So that's good. Another thing that was brought up, what about a minimum face amount universal life policy? And that's another great option. When you have permanent life insurance, there are a few things you can do with it. And as long as there's cash values and it's not a MEC or a modified endowment contract, you can take withdrawals out of the policy income tax-free. And as long as there are cash values in the policy, you can continue to take income tax-free loans against the cash value of the policy. And as long as the policy has a positive cash value at death, then there's a death benefit paid, and there's no income tax due. So one option would be for Lucienne to take the 1035 exchange, and instead of using the $663,000 to maximize the death benefit, we could look at a minimum death benefit. And so in this scenario, it might be $300,000 or so, and allow the cash values to grow, accumulate, to almost have it look more like an annuity, but with some extra tax benefits that we could take withdrawals up to cost basis out first, and then take tax-free loans, which would be an option you couldn't do with the annuity. Option number 5. So thanks, everybody. Option number 5 would be a 1035 exchange into a hybrid life long-term care policy. Many times these are called asset-based care plans, or ABC plans, where the last life insurance option I talked about, there would be maximizing the death benefit. The idea here is really to maximize the long-term care component of the policy using the life insurance chassis. And so there's really a few different buckets. There's a long-term care bucket. So this $106,000 provides X amount of long-term care benefits if Lucienne ever needs it. But if she doesn't, there's still also a death benefit too. So if she uses it for long-term care, there's bucket number 1. If she never needs long-term care and dies, then there's a death benefit from bucket 2. Or many of these asset-based care policies, because they're designed to maximize the long-term care benefits, minimal death benefit, they also have some return of premium options built in. So looking even a little bit closer to an annuity at that point, but so that the cash values that go in may be available at some point in time if the client decides, I don't need it for the death benefit or long-term care coverage. So for Lucienne, I think I said 106, 102. This particular asset-based care policy, one idea was after 5 years, this policy would guarantee 100% return of a premium if she decides that she doesn't need the policy. So there's a return of premium feature. If she keeps the policy, so doesn't surrender it and get all of her money back, and she dies without ever needing the long-term care benefits, and then it guarantees a death benefit of $140,000 per year. Now, this isn't really necessarily very exciting on the life insurance death benefit side, but it's not really the focus of these policies. The focus of this policy is the long-term care benefit, and they're designed to look just like and have options just like a traditional long-term care policy. With this particular policy, it would have a long-term care benefit of $5,800 per month for 4 years with a 3% compound inflation rider. And so her long-term care pool that she'd have available over 4 years is just under $300,000 the day the policy is issued. So that's what makes this policy attractive. It has, a client has cash values. I have a 1035. I like the idea that my money doesn't just go away if I ever need it. I like my kids but don't like them so much that I want to maximize the death benefit. But Lucienne and boyfriend say, you know what, the long-term care part is part of the plan that we have been not able to really come to a conclusion on. And I really like this idea because if I ever want my money back, I can get it. I know that if I die and don't need the long-term care, somebody's getting more than what I put in. And if I need it, I took my $102,000, and next year it's $300,000. And at age 86, my $102,000 is over $800,000 of long-term care benefits. So this is a really neat idea for someone who has cash value in a life insurance policy. They may have had whole life for 20 years, 30 years. They used it for the death benefit in case something happened to them while their kids were small, or income replacement. But over time, the needs have changed from not worried so much about income replacement or death benefit. Now I'm more worried about taking care of myself, running out of our assets if we need an extended period of care. And so this policy provides for that. What's the planning plus? There's a minimal death benefit included in her taxable estate. Again, I'm sure that not all of your clients are like Lucy Ann, that they're $4 million net worth and retired at age 52. I sure hope that that's my profile in a few years. Not counting on it, but that would be pretty cool. But again, we're looking at this taxable estate thing. $140,000 of death benefit is minimal for that plan. It's a very large long-term care pool of benefits, and we can make it all tax-free. If the benefits are accessed from the long-term care rider, those are income tax-free even though there's gains in the policy. The death benefit passes income tax-free even though there's gains in the policies. And yes, there is underwriting on these types of policies. They are generally a little more lenient than a traditional long-term care policy, but there still is underwriting. These aren't guaranteed issue, but many times they're definitely a simplified sort of underwriting. Option number 6, 1035 exchange to a hybrid annuity with long-term care benefits. So again, 1035 requires us to move the cash values from an insurance policy to an insurance policy. In this case, she has a life insurance policy, so we're looking at what options do we have to move it to another life insurance policy or to an annuity insurance policy. Option number 6 is a hybrid annuity with long-term care benefits. Defers the taxes on the earnings. The 1035, there's no taxable event when that happens. And if the cash values continue to grow, it's all tax deferred. The hybrid annuity, it creates a larger pool of long-term care benefits than the annuity values. That's what's just really cool about these. With the annuity, they also have access to the cash values during their lifetime. Now, if they take money out of the policy, then it's obviously going to impact the cash values and it's going to impact the long-term care benefits, but they have access to it. The cash values didn't go away just because they have a long-term care component. If they decide they don't need the coverage in 5 years, 10 years, 14 years, then there's still an annuity cash value that they can have access to. The annuity cash values are included in their taxable estate, or her taxable estate at death. And at her death, if they never use it for long-term care and it passes on to her beneficiaries, the beneficiaries owe taxes on the gains. Again, almost all of that is, except for bullet point number 2, all of the rest of that is the same for any annuity. But what does this look like when we add the long-term care component? So we have Lucy Ann and Jake, and they have, wait, there's Jake. With the hybrid annuity, we can include a spouse, in this case, live-in boyfriend. This is the first time we've been able to take a 1035 exchange on a policy for one person and add a second person. With the hybrid annuity, a spouse, a partner, can be considered as an eligible person to receive long-term care benefits, even though, in this case, Jake isn't the annuitant and isn't the owner, but he can be an eligible person for long-term care benefits. So this can be really cool when we have one of a couple with the cash values in a policy. We can do the hybrid annuity and add the other spouse partner as eligible for the long-term care benefits. And with hybrid annuity, in this case, there's 3 different options that they can elect. And for the cash values, they have a long-term care accumulation value, which is pretty close to the cash values, and then the extension to create the total long-term care pool. So for Lucianne and Jake, they can have a long-term care pool of $229,000, $353,000, or $462,000. How the policy works is that, let's say they start using the policy. They reduce their cash value, and they reduce that LTC accumulation value. So if we look at option 2, and all of a sudden they can use up the policy, they've used up $105,000 of benefits from the policy. The cash value is essentially at 0. The LTC accumulation value is 0. At that point, they've exhausted what's pretty much considered their own money in the policy. And then the LTC extension is then where the insurance company is on the hook for another $250,000 in long-term care benefits. So it sometimes is thought of as a catastrophic long-term care policy. I like to think of it as self-insuring with a bonus. I might put $100,000 aside, and I know that's my rainy day long-term care fund, but if I need it, it's $100,000. This is a great way for clients who might self-insure, you were going to separate money, put it in a fixed income account, well, put it in this fixed income annuity, but if they use up whatever's in that account, that annuity, then they have an extra $125,000, $250,000, $362,000 that's protecting other assets from being spent down. Now, what's the planning plus here? As I mentioned, because we had that picture of very handsome Jake right there, we can cover live-in boyfriend. And wow, I'm fast on the down arrow there. We can include the live-in boyfriend as an eligible person for the long-term care benefits. And of course, a spouse would be too. But it's pretty neat in Lucianne's situation that's an option. If she wants to provide for him and provide for that some portion of long-term care benefits. The other sort of neat thing about this policy in this situation is Lucianne remains the owner and annuitant, which means she's the only one who has access to the policy cash values, to name a beneficiary. He may be an eligible person. He may be an eligible person on the long-term care benefits of the policy, but he doesn't have rights to take money out and do anything else to it. If they access the benefits for long-term care through the rider, it's income tax-free compared to a straight withdrawal. A regular annuity, they withdraw money out, tax out, earnings out first, tax as ordinary income. When you use the annuity, the long-term care benefits from the annuity, money's coming out, and yes, some gains are coming out, but it's income tax-free because the benefits are paid through the long-term care rider. Now, the second thing I'm going to touch on, because it's sort of different, and those were all options that made sense for Lucianne, great things to think about. Another option is to do a 1035 exchange to a term UL policy. I'm going to touch on this a little bit, and I'm going to give you a case study where a client, this makes a lot of sense. But a term UL is essentially a universal life policy with a fixed initial premium that looks like, smells like, tastes like a term policy. But because it's a universal life policy, it's a flexible premium contract, and so it can accept a 1035 exchange. It can be paid off initially, paid quicker, faster. So it's an option, but it's not needed or advisable in this case. Why do I say it's not advisable? Because her 1035 exchange would provide over $3 million of 15-year term with no annual premiums. Well, she's retired, so we don't really have a short-term life insurance need. She has a $4 million estate already. $3 million shoots her way over the $5 million and change. So it's an option, but obviously for this client, it wasn't one that we posed because it doesn't, first of all, it just doesn't meet her needs. So not for this client. But what about other clients? I'm going to take a look at Matt and how the term UL, the 1035 exchange into a term UL works for Matt. Matt's 40 and he lives in Arizona and just had their second child and realized it's time to talk to a fee-only financial planner. The advisor recommended $2 million of life insurance for the next 20 to 30 years for an income replacement need plan. What did Matt have? He had $750,000 of an indexed universal life policy that his college roommate sold him at the birth of their first child. And it was designed to be college funded, retirement planning, death benefit. It slices, it dices, it Julienne's. And he was paying over $1,000 a month for this policy. So knowing what he has, what his options were, what was the recommendation? Well, the first thing we looked at was the cash values in his existing policy. You do a 1035 exchange of the $11,000 he has into an existing $1 million 20-year term UL policy. So this is a $1 million life insurance policy with a fixed premium for 20 years. And it was obviously not $30 a month, but because we used the $11,000 up front to reduce the ongoing premiums, he was only going to pay $30 a month for that policy. And then we added a $1 million 30-year term, creating a term layer here for another $129 a month. So he has $2 million of coverage for the next 20 years, $1 million of coverage for 10 years after that. So we increased the life insurance from $750,000 to $2 million, and we reduced the premiums from over $1,000 to $159 a month, saving $869 per month. Now, for any of you who have kids, you know that $869 a month comes in handy. Diapers are very expensive, and that baby food that we used to buy, whew, that was pricey. So that $869 comes in very handy every month. But not only did we find them a lot of extra money per month to go towards other planning goals, we got them the right amount of coverage. What are some other 1035 exchange ideas? This is my option 8, and it's December, it's the last one. I'm giving the presentation, and I get to talk about one that I think is really neat. We're going to annuitize a loss. You say, Mark, why do we do that? But we're going to talk about it. Daryl's 48, and he has 2 whole life policies. He has a cash value of $174,000, and he has a cost basis of $225,000. He's paying an awful lot of premium. The premiums are just much better set, spent doing other things with it, term life insurance. So the advisor asks us, what can we do with these policies? He's not in a horrible loss position, but there's a loss. We know we can't deduct that. So if he surrenders the policies, he gets his cash value, $174,000. And he gets it all income tax free. Again, not necessarily a bad problem to have, but he's paid in over $225,000. The IRS says in life insurance policies, you can't deduct this loss. If it was an investment, we would. Because it's life insurance, we can't. But what can we do? We can combine those policies into one big lump cost basis and into one big lump cash value and turn it into a single premium immediate annuity. So we designed this immediate annuity so that he will receive $225,000 in payments, and he will owe 0 tax. Why? The IRS says you can receive the money back up to your cost basis and not have a taxable event. So we just run a calculation to figure out how long does it take to pay out $225,000 for an annuity using $174,000 today. Well, the immediate annuity for the $174,000 will pay $1,082.70 per month for the next 17 years and 4 months. The sum of the payments being $225,000, $225,202. 0 gain, 0 tax. So Matt can surrender today for $174,000 and pay no tax, or get $225,000 spread out over the next 17 years and still pay no gain, no tax. We can't deduct the loss on a life insurance policy. So that's why I think this is pretty cool, to be able to recover all of the premiums paid and owe no tax. I love this graphic of this guy. What's the problem? Not necessarily a problem to me because I'm relatively tax averse. I think this is really cool. The problem or concern is that it takes 17 years for him to get his money back. That's the only downside here. What's a planning plus? In that scenario, client had 2 whole life policies. Both were in a loss position. Now we have a different client who has 2 whole life policies. One has a large loss. One has a gain. When we separate, each policy is looked at separately by the IRS. If he surrenders them both, the large one, he can't deduct that loss. The smaller one, if he surrenders it, he owes $12,000, owes tax on $12,000. Again, if this was an investment and we sold it, we'd offset gains and losses. The IRS says with life insurance, you can't do that. But when we do 1035 exchange, we combine the loss, we combine the gain, and that gain is absorbed by the loss in the other one. And let me show you what this looks like. Policy 1, there's the cash value, there's the cost basis, there's the large loss. If he surrenders this policy, he gets the $75,000 income tax free, but that's it. Nothing to deduct. No benefit for that loss. Policy number 2, smaller policy, has this gain. If he surrenders these policies at the same time, and on policy 1, no particular benefit, and policy 2, there's a $12,000 gain. By combining the two, combine the two into one bigger lump of money, we have a combined cash value, and we have a combined cost basis. And so now everything's looked at individually, or not individually, but as one new individual plan. So in this case, instead of having a $62,000 loss that we can't do anything with and a $12,000 gain, now we have a $50,000 loss that we can't do anything with. If we surrender it, he gets all of his money back but owes no gain, so that's always a plus. Or annuitize into my idea and recover that money. So what did we look at? We looked at, the advisor called us and asked, Mark, what are some great options here? Surrender. Here's the pluses and minuses. Single premium immediate annuity. Fixed deferred or variable annuity. Single premium universal life policy. And again, it can be a no lapse policy, could be a minimum face amount policy to accumulate. The hybrid policies. What if long-term care is that planning gap that we quite haven't been able to figure out a way to protect our clients for? Hybrid annuity with the long-term care benefits. We want to cover both people, Lucienne and her boyfriend, on one policy. How can we do that? The term UL policy doesn't work for Lucienne, but works for some clients. Annuitizing the loss. Again, greatest idea that no one's interested in. But a couple of you have already said that you like my idea there. So thank you all very much for liking my idea. And actually, I say nobody, but a few people have liked that idea, and we've actually helped them with it. But again, it might take 17 years. So that's the wrap up there, and I have some people who have chimed in and sent me some questions. I'll get to those in just a second. But we are presenting at the Garrett Virtual Insurance Workshop just next week. And don't forget to come to Florida, February, for the LLIS Insurance Academy. I love this picture of the sand snowman. February, Florida. What else do I need to say? If you're like me, Florida, February, insurance seas. Next year, we are going to be working through a family and all the different things that are going to pop up as we go through one family and sort of their generational issues as far as they relate to insurance. And so we've already started sending information out about these, and these will start in March after our Insurance Academy in February. That's one of the things that makes us different, are the education offerings to fee-only advisors. We're not your competition. Our only clients are fee-only advisors. And for many of the names I see on who've tuned in, you've worked with us, many of you, for years. And so we thank you, especially right after Thanksgiving. I'm very thankful for all of you. New names, existing names, so thank you all very much. But we work to save you time and your clients money. We do a lot of pre-underwriting and provide tools for you and your clients on our website. We proudly sponsor a number of different fee-only planning organizations. And thank you all for tuning in to our presentations. Many of your names I see regularly, so again, thank you all very much. We have specialists in many different insurance options and ways to help design programs that fit your clients' needs. And it's not just initially, we help keep you and your clients, keep you in the loop with your clients through our AIM or application information messages to keep things moving and to keep you in the loop. And we help keep your clients' policies in force, ready, there with our APE. I love that monkey. The APE, the advanced premium emails to let your clients know your premium is going to be due. Pay attention. The notification of term expiration. And this is letting your clients know that their term policy is coming to the end of the expiration date and what options do they have. A few questions. One question was, in the MAT example, why not just take the $11,000 since it wouldn't be taxed and then buy term? That's a good question. That's an option, and that's part of a recommendation from you as the advisor. Is your client very diligent? Are they going to take the $11,000 and do something, let's not say good, but do something that you want them to do with it? Or some clients are much more, some clients are good with assets, some are much better when we talk about cash flow. In that particular example, the advisor and the clients were much more, they preferred the idea of lower cash values than having the money and paying the higher premiums. So to them, the cash value was already there. They weren't using it. They weren't doing anything with it. I'd rather take that and turn that into lower premiums for the next 20 years. Question, have you found insurance companies to be good at tracking the cost basis, or is the info hard to find? It's required to be reported from insurance company to insurance company. So if you call an existing insurance, if your client has an existing policy and you call the home office or the toll-free number, they should be able to get that to you, if not right there, very shortly. When cash values are transferred between insurance companies, they report the cash value and the cost basis as well. One question, doing a 1035 exchange using the cash value in a life insurance policy to one of the long-term care hybrid policies, is there medical underwriting? For the transfer of life insurance to the life insurance with long-term care benefits, yes. As I said, they're a little simplified. With the hybrid annuities, I believe there's 4 health questions. I think one of the questions has sub-bullets A, B, C, and D, but very streamlined there. There's a few knockout questions, but for the most part, it's pretty streamlined, and so the hybrid annuity is a great option for even somebody who may have a hard time getting traditional long-term care, but then they have the ability to have that hybrid annuity coverage. All right, well, that's the end of my time. Thank you all very much for attending, and have a great rest of 2014, and we will see you in 2015.